So a very warm welcome on behalf of the entire team at Crystal. Thank you everyone for joining us today. And today we are going to talk about the private credit space. Shyamal, can I just request you to be on mute for now? Thank you. So before we begin the session, let me first introduce and welcome our guest for today. So we have with us Mr. Amit Agarwal, who is the President and Head Private Credit at Edelweiss Alternatives. Amit has over 2 decades of experience in private credit and special situation finance, corporate finance, investments, deal structuring, deal origination, investment banking, and fundraising, and much more. Amit is one of the founding members of the private credit business at Edelweiss, and he has played key role in business development and growth. He currently has direct oversight over $4.5 billion of asset under performing credit, real estate credit, and special situations fund. Prior to Edelweiss, Amit was associated with Arcel and PwC. A very warm welcome to you, Amit.
Thank you, Anjali. Thank you.
We also have with us Mr. Shyamal Karmakar, who is the MD and Chief Investment Officer India at RV Capital. A very warm welcome to you as well, Shyamal. And I am Calcutta and NIT Bhopal alumnus. Shyamal has over 26 years of experience. He's currently leading the RV Capital's India team. He specializes in credit, structured finance, and fixed income trading. He has previously worked with Morgan Stanley, DSP Merrill Lynch, and Robo India Finance. Thanks for joining us, Shyamal.
Thank you for.
Thank you. So we look forward to learning more about private credit, Indian and specifically Indian private credit market from both of you today. But before we start the session, let's start with a quick poll and understand where do we stand at this particular point on the private credit space. I'll introduce a poll. On your screen, you would be seeing a question which is basically saying, as an investor, have you ever explored private credit space? Or you would have just heard about it, or maybe just, you never came across it. So let us know your choice. Another 10 seconds to answer the poll. Great. So happy to see that a majority of us, at least more than 88% of us, we either have invested or we would have heard about it. So I think this is a great session to know more about it. If we have not started investing or if we are unclear about any of the aspects, feel free to drop your questions on the Q&A box or on the chat box, and we'll address that along with various other subtopics that we are going to cover in this session. Before we move ahead, I have another small poll where I want you to just take an estimate in terms of what's the global size of private credit in terms of AUM, and that would be by the end of year 2023, how it would have been. Another 10 seconds to answer the poll. Great. So this is what basically we, as an investor, as a general public, we think about it. So the right answer over here is 1.8 trillion is the global size of private market, private credit as per last year. So great to know where do we stand at, and I think that sets the tone for this particular session. But before I hand it over to my speakers, just a quick introduction about private credit. So over the past decade, we have witnessed a gradual ascent in the private credit landscape. The private debt AUM crossed $1.5 trillion mark in 2023. And as discussed in the poll as well, it stands at 1.8 trillion US dollars as of now. Moreover, we have more than 108 funds which were recorded in this particular space, which raised more than $131 billion. It is also predicted to expand to 2.3 trillion by the year 2027. And coming to in India specifically, in emerging markets like India, the first half of 2023 saw 12 deals which surpassed more than $100 million, which was just 15 in the whole year of 2022, which basically shows us that, this is picking up trend, this is gaining traction from investors, and there's a lot of demand in this particular private credit space. Isn't it interesting to know about these particular facts? So in today's session, we'll understand in depth about the private credit space, and we'll be touching upon the scope, the current landscape, structuring, regulatory aspects, risk return dynamics, challenges and opportunity, and finally, how to go about an investment if one is convinced to do so. So let me start the session, and let me first begin with Amit. So Amit, we would really like to know and hear it from you in terms of what is private credit and how is it different from the traditional forms of financing? Over to you, Amit.
Oh, thank you, Anjali. And I think those were some good insights. And it's good to see all the audience knows, almost 90% of the audience has heard about private credit and has invested in it, and fair good sense on where the market is. So, simply put, I think private credit is a form of lending which provides bespoke, flexible financing solutions which take care of the needs of the corporate in a high growth environment like India. If you see globally, the banks and financial institutions are very oriented towards a corporate lending setup which provides for the working capital financing and sort of their regular needs. But if a corporate has a slightly differentiated need where there are long term maturities, where there are situations where the client may not want to be paying too much of interest but would be willing to participate in an upside situation which the banks can't do. So, in a regulated box, the banks do vanilla lending. Outside of that lending box, which the banks, and you can include non banking finance companies into that. So, banks and NBFCs, whatever they lend, outside of that, all the lending you can club as private credit. And private credit provides very similar risk profile as a normal banking credit, but the focus of the private credit teams, because they do very small amount of deals, and like banks, they are not doing thousands of deals in a year, they do very focused transactions. So their structuring skills, the risk profile, the collateral assessment of private credit is very different. So very simply put, it's a financing which is outside of the bank stroke non-bank channel, which provides flexible financial solutions to the clients and take cares of the need which can't be met from the banking system. And the segment has seen growth, and especially in India, the segment has seen a lot of growth because in a growing economy, the need of these sort of financing solutions is much, much higher. A very interesting fact I will give you about the private credit of India versus the private credit in, let's say, US, which is one of the largest markets of private credit. 70% of the financing of private credit in the US markets is what is called sponsor financing, where the private credit funds are financing the large private equity funds like the Blackstones, Carlyles, Brookfields of the world, helping them do acquisitions and completing companies. That is 70% of the private credit market. While in India, it is 0%. There is hardly any sponsor financing yet available in India. And it is because of the pricing, the regulations, multiple other natures, but that sponsor financing is nil in India. And despite that, the India's private credit market has grown to where it is. So I think private financing, credit financing provides a very superior risk adjusted return to the clients. And they can look at it as a diversification in their portfolios, which for clients have largely been either equities or plain vanilla debt. So I think this is the point where it provides you return higher than the plain vanilla debt with a lower risk than equity structures. So that's what private credit aims to do.
Thank you. Thank you so much, Amit. In fact, you mentioned a couple of very interesting points about the risk return dynamics, and we'll come back to you to learn more about that aspect a little bit later. Before I do that, I want to go to Shyamal and basically understand from him Now that we have an idea about the space, you have briefed us about the space. So I wanted to learn from Shyamal in terms of what do you think is the current landscape of private credit in India? And briefly, of course, Amit also touched upon this, but Shyamal, if you can just help us elaborate a little bit more.
So if you look at the the historical perspective in India, so broadly there have been three funding sources when it comes to debt. One is obviously the bank financing. Second is the public bond market, which in India is typically high yield because there's typically is high grade because there's no high yield bond market in India. And third is what is known as non-bank financing companies or NBFCs. So these are the three main sources, and historically, typically banks would finance capital expenditure, working capital financing, the traditional kind of financing. While the bond market will typically be open to really high rated companies which are rated AAA or AA on the national scale. Bond market was not really open to the lower rated companies. So obviously there was a gap, and this gap was being filled by NBFCs, which had, though they were also they are still regulated by RBI, but they had certain leeways vis-a-vis banks in terms of the end use, in terms of the structures they could do, in terms of collateral they can take. And this was the kind of kind of pattern which we've seen since the early 2000 till about 2018. And it was essentially the fact that most of these NBFCs were essentially leveraged structures, and there was an inherent asset liability mismatch because the funding through the short-term sources, market sources, because they would borrow, they were rated NBFCs borrowing from the market, but investing in illiquid assets. And in India, anything below AA has very low liquidity. So obviously that kind of led to some amount of ALM mismatch, and ultimately leading to a 2018 crisis wherein large NBFCs such as ILFS defaulted, which kind of changed the entire scenario because then NBFCs started refocusing away from wholesale lending to retail lending. So that kind of opened up the space a little bit, and then we had a small incident from the mutual funds which are also doing a small amount of AUM investing in private credit under so-called credit risk schemes, which again there was an ALM mismatch because these are daily liquidity schemes, while again the assets were not very liquid. The quality of assets were not in question, but I think the liquidity was always a question. So again, we had an issue in 2020. They had to get some of these funds, which kind of essentially opened up the space for what we are seeing now is the growth of the private credit on a fund platform. Now, AIF has been is a structure which has been around since 2012. Initially, it was mostly used by equities, which are the main really asset under this segment. But since 2018, this segment has really grown a lot. I mean, overall, the segment has grown by almost 35%. Today standing at $30 billion. If you look at what is known as the category 2 AIF, which incidentally is probably optimal structure for a private credit kind of a situation, because what category 2 does is that it doesn't allow the fund to take any leverage. Secondly, mostly these are closed-ended structures. So what happens is in a private credit situation, it is easier to take a call on the credit risk, but it is very difficult to take a call on the liquidity, because you don't know if you want to sell it because there's a redemption request which has come in, whether you'll be able to sell it. And that has been the cause in India, and that has been the cause incidentally in 2008 when the global financial crisis also happened. It was not really just the asset quality, but the ALM mismatch caused by the asset liability, by the asset quality, which really drew down the crisis, created the crisis there. So to that extent, this I believe is kind of emerged as an optimal structure. And I mean, already mentioned globally the segment is growing, but within India also has been growing very strongly. If you look at the segments, grown very strongly, over 30-35% since last 5 years. And we just getting started. I think we're going to see a significant growth from here onwards. We are standing at a 15 billion kind of a AUM, which is there right now. I think there's estimates in the market which says this can go up to 60-70 billion, which means around 25% CAGR. So I think future is pretty bright for this segment. Now that there's a vehicle which kind of makes sense to really invest in this kind of assets really. And to add to Amit's point, I think also what is driving this demand is also the fact that two other factors were driving the demand. One is of course the pricing correction which has happened, because earlier many of the other players were really looking at asset book creation rather than really the pricing and the risk. Now these assets are getting priced properly, so there's a price discovery which is happening, which is making the segment attractive from a risk return perspective. Secondly, we are seeing more, because of the macro strength of India, we are seeing more capacity creation, more M&A activities, which again is a very, very fertile ground for private credit, because, for example, banks are not allowed to do acquisition financing, they are not allowed to do buyouts because there are restrictions. Obviously, it is fair. But then this kind of opens up the opportunity for this segment, which is really somewhere in between, which is kind of looks at only the risk rather than looking at other things like capital charge or end use or collateral, because there's a lot of flexibility in that segment. So that's the, I think, way I look at it.
Great, great, great. Thank you, Shamal. That was really insightful to know about it. So before we move ahead, I'll just request our audience to drop in their questions in the Q&A chat. And those who have raised their hand, can you please type out your question in the Q&A chat, and we'll take it during the session. And in fact, before we move ahead to our next topic, Amit, to you, there's a question basically which I want to address to you. In terms of in your experience, what has been your experience with Indian courts when it comes to enforcement of creditors' right? And a sub question along with that is, do you try to get a bilateral solution with the borrower to avoid the court, or which legal instruments do you have? I mean, as an investor, would you have to enforce the right?
So, Anjali, would you want to do all the question answers towards the end, or I can answer this one, but I think it'll be more efficient if we put all the questions towards the end. Maybe I will take this question and
Sure,
then
sure,
we
we
can
can
put
do
all
that.
the questions towards the end to avoid breaking the flow of the conversation. But I think I have been in this market for 20 years, and I must tell you, the last 5 years have been a sort of a delight for anybody in the credit space who has lived the 15 years before that, right? So there has been a meaningful change over the last 5, 6 years in the behavior of the courts, in the behavior of the borrowers and the creditor rights, and which is largely driven by the bankruptcy court process in India. 15 years back, when we used to lend credit, the only recourse for the creditor was to attack the asset if things went bad and take over those assets, sell those assets, strip sale the plant, building, and machinery. Typical recovery cycles were 6 to 8 years, and a typical recovery in a bad case was 15 to 20 cents. The bankruptcy court, post 6 years, even on an average basis, have returned 45 cents in a 2 to 3 years period. So that has crunched the timing meaningfully and expanded the value that the lenders drive also meaningfully. On the heavy assets industry side, that is where there's infrastructure and other things, the recoveries have been in the 70 to 100% range also in the bankruptcy court. So I think Indian courts have meaningfully understood what it is for a growing economy to implement its bankruptcy court. And I think we are following through on that. Again, a very interesting, and we keep on comparing ourselves with US markets. When US introduced its bankruptcy court, US was a $2.5 trillion economy. And India also, when did its bankruptcy court, was around 2.2 trillion dollar economy. US bankruptcy court took 10 years to stabilize. I think we have, in today's time with technology and all, and this is all 1980s when US did their bankruptcy court, we have done much faster work on the side. We have a lot of technology to our advantage. We have got now a central repository for creditor claims. So I think our experience in the Indian courts has dramatically improved over the last 5 years. And the second thing that I would like to state is on the sub question. I think no resolution, if a deal has gone sideways into credit, like I'll tell you, we have invested almost $3 billion over the last 10 years in private credit alone from Edelweiss Alternatives, and over 172 investments. We have not lost capital in single one of them. Now, that is predominantly because a large part of investments by us have been made over the last 6, 7 years, and the court process have allowed us to exit some of the assets which go sideways also at a fairly good prices. The resolution of an asset is never a single pronged strategy. So it is not like we will only go to the court, or we will only do bilateral negotiation, or we will only do asset sale. I think it is a very overarching process which has to be looked at in a multi-pronged approach. So a borrower will never do a good bilateral negotiation if he does not have a court threat in front of him. Similarly, only a court threat might not yield you anything if you are not looking at a bilateral negotiation. So you have to look at the commercial wisdom of what you need to take as a decision. And I think that is where it is very important to have the right set of domain knowledge, the right set of skill sets, the right set of local understanding. And we are classified at $4 trillion. We are already the fifth largest economy. Soon we will be the third largest economy in the world in 5 years' time. And at that time also we will be called emerging market. So it is not like we will become a developed market just because we go to the third largest economy in the country. And the only reason for that would be that people still want to see how we behave with our contracts, how our courts enforce the rules, let's say how much corruption has gone down, how much ease of business has gone up. I think we are making a multi-fold progress on all these parameters. And there will be a time in the next decade, and that is why I'm saying the private credit headroom is much larger, because as and when we mature into these areas, the credit inflow will become much, much more stronger. And people will be willing to borrow more and people will be willing to lend more. So the short answer for the question is, I think the court and enforcement rights have significantly and materially improved. The contracts in India are all high covenant versus US, which sees a lot of less covenanted market. India continues to be high covenant, and there is a lot of improvement in creditor rights. So our experience has materially improved over the last 5 years, and so has for all the investors in the country.
Great, great. Thanks, Amit. That was quite comprehensive, and I'm sure it was quite useful for all our audience over there. So, basically, in brief, we also wanted to know from you, Amit, what are the key features and structures commonly associated with a private credit transaction?
Sorry, could you repeat that question again, Anjali?
The key features and structures associated with a private credit transaction, the different kind of structures available.
So I think we try to keep the structures fairly simple and not complicate too much on the structures. And I think India continues to be a strongly regulated market. There is very less innovation, as I would say, in structures. I think the lending is predominantly vanilla. The instruments are non-convertible debentures. I think most of the structuring is around the returns, which could be equity linked upside, could be synthetic upsides, could be participation in profits. The real structuring could be also, so it is either non-convertible debentures or optionally convertible debentures, or debentures plus warrants, or debentures plus equity. So it all depends on what deal it is coming in, but in most forms it is secured lending, and the instrument that is available is a debenture. Now, equity upside participation can come through a optionally convertible structure, could come through a compulsorily convertible structure, but all of that is more on the return and the commercial wisdom side. So I think that's something which we are very, very sort of excited about, because we do not have a lot of other structures as yet coming into India. So as and when they come in, they will also expand the market. Like, we don't really have a large credit default swap market in India. We don't have a large derivative based lending in India. We don't have a lot of what I should say, leveraging. Like, leveraging is not allowed in AIFs till now. So you can't do any other structure inside to enhance the investor returns through leverage. So I think India is an evolving market. We are at a nascent stage. The structuring is simple, and I think it is good to have a simple structure in a credit format. And I think Shyamal will also surely have a view on the structures in the market.
I totally agree with it. I think it's actually simpler the better. I think that has been the case. Usual stuff is always there: escrow, cash flows, and security. Ideally, a exclusive charge, but there are cases where you will have a pari passu charge as well. But yeah, I mean, we have not seen kind of stuff which has been prevalent in the US CDOs. I mean, even the PTC market is not. It's pretty limited in terms of from the point of view of private credit. So we're not really seeing too much of that. It's more about the management. It's about the collateral quality. I think that is really driving and the cash flows, of course. the cash flow, collateral, and management quality. I think these are the three mantras really, because ultimately, no matter how much you structure it, these are the things which will determine your essentially whether you get paid or when you get paid, how much you get paid, etc. So I think it's very important to really focus on the key factors rather than getting lost in too much of complex structuring.
Got it, Shamal. Thanks, Amit. Thanks, Shamal. Before we move ahead to our next question to Shamal, let's launch a quick poll again, just to understand in terms of where do we stand about our expectations on the risk return dynamics about this particular asset class. Another 10 seconds to answer the poll. Great. So Shamal, this is where our particular audience is standing at this particular point of time. Just to add on to this, we wanted to understand from you in terms of what are the risk return dynamics in private credit investment as compared to rest of the asset classes.
Okay, so yeah, so I think I broadly agree with the poll results. I would just modify a little bit. So I would say, moderate to high return with moderate risk is probably a better description. And I'll come to why I think so, because if you really look at the private credit market, the key risks, of course there are key risks, the risks everywhere, but the key risk for private credit, I would say there are four key risks. One is the liquidity risk, because time and again we have seen the liquidity is and it can make or break any structure, any asset, any investment. So liquidity is number one. Then credit risk, obviously, and third I would say interest rate, market risk, and fourth will be mostly legal and structure kind of risk, regulatory and legal and structure risk. Now within this, if I look at the liquidity risk, now as we discussed earlier, it is very important that what is the choice of the vehicle, because time and again we've seen it is not the underlying asset but the choice of the vehicle which kind of creates issues, whether it's the mutual fund situation we talked about or the NBFC situation we talked about. So I think something which is, if you are looking at a medium term exposure, you are really taking a call on the cash flows or the repayment ability of the company. But if you are really forced to really sell that asset midway because of some other ALM issues, then you are not really going to have an optimal outcome. So the choice of vehicle from that perspective, category 2 without leverage, closed-ended structure makes more sense. Having said that, investors who invest in this structure have to understand that it is not something which will be a daily liquidity, because if they want a daily liquidity, this is not the product for that. While it is medium term, it is obviously not as long term as a private equity, because in private equity you are exiting through an IPO or strategic sale, etc. Here you have contractually entered into, you have a financial obligation which the issuer has, where you have a contract in place. As Amit mentioned, there are mechanisms in place to really enforce that. So typically your tenor will be lower than a private equity, number one. Number two is that time and again we have seen that good companies or good issuers don't want their the high yield debt to remain on the books for long. So there will be a lot of prepayments, which is a very common phenomenon, and one should be ready to take these prepayments because that's a good thing. Which essentially means that the average holding period in this kind of a vehicle is not very long. So people have to stay invested, but not as long as the private equity. But this structure, I think, in a way, the AIF category 2 structure really takes into account the inherent illiquidity which is there in private credit as an asset class, and really manages, kind of that liquidity risk, to an extent, mitigates the liquidity risk to an extent. Now, second one is the credit risk. If you come to the credit risk, obviously, it's credit. Obviously, there is a credit risk. Credit risk is there everywhere. We have seen sometimes AAA bonds default. So it is, I think, rating alone, for example, is not really a reflection of the credit risk always. It is obviously a probability issue, but I think what really matters here is that what kind of due diligence is done, what kind of covenants are put. I mean, as Amit mentioned, again, the US covenant light. I think in India, the way the market has developed organically, what really has happened is that if you look at particularly performing private credit, it is essentially not much different from a bank loan or bank debt what the bank gives, with the difference that this is for a end use which a bank cannot do. So your credit risk is not, for a performing credit particularly, is not that different from what a bank would lend. Only the maybe end use is different, collateral structure is different, capital charge is different, and those kind of things. Having said that, it is obviously there's a risk involved, and obviously there's a return also there. Question is that whether returns justify the risk or not. I would think at the current scenario where we are sitting, where the there's a repricing which has happened because of the changes which I mentioned earlier, we are at a situation where I think the return justifies the risk. But obviously, it's important that the manager has the appropriate team in place which has seen cycles, because history tends to repeat itself. Like we have seen 2001, 2008, 2014, 2018. One has to know the history to know that what can happen in a down cycle and be ready. And things cannot be always hunky-dory the way things are right now. Things can always go bad, because that's the nature of the macroeconomic scenario. And when there's a macroeconomic stress, it also impacts the companies. So the team should have seen the cycle. They should be monitoring the credit, taking early actions, and there should be multiple backup plans for exit, not just the cash flows. There should be other, I mean, whether it's negotiation, whether it's sell down, even though there's no much liquidity, but it's always possible that somebody with a better or a higher risk appetite may be willing to buy something if you want to exit something. And of course, lastly, the enforcement, the insolvency and bankruptcy code has been a game changer 2016 onwards. It's not optimal yet. I mean, there are obviously a lot of improvements required, but it has really kind of made a lot of change in the credit discipline in the market. So that really helps. But yeah, credit risk is other risk. Market risk, I would say that it's not a big factor here, because we are not really dealing with the open-ended structure, with the daily liquidity structure. So market risk and interest risk are to an extent, kind of related. That really matters. If you have to sell something and interest rates go up, you have to sell your bond prices will fall, or your asset prices will fall, and you sell at a discount, which is not the case here. Again, you hold to maturity. Now, second part is that this category is not very sensitive to interest rates. So underlying benchmark curve may go up or down, but the pricing on a private credit does not move as much. Mainly because what determines the pricing on a private credit is the demand supply scenario, the scarcity value of the providers, rather than the underlying benchmark curve. Though it does have some impact, it has an impact in the reinvestment part. So for example, if you have invested in a private credit, and let's say there's a prepayment that comes in, so you can actually the manager has to then see whether there's an opportunity available in the market to reinvest. If not, then they should just distribute that. So to that extent, there is a risk, because you may get prepayment, and that point in time the pricing may not be as great. But otherwise, it's not really a big risk. And legal and structure risks always there. I mean, you have to have people who understand the regulatory environment, understand the legal aspects, how deals are structured, what to look for it, what are the covenants to put in place. So I think that is very important, which comes very specifically to the kind of manager who is managing that fund, what kind of understanding they have, what kind of experience they have. Because NCLT, bankruptcy code, all works fine, but it's very important for the people to know how it works, and for every kind of as security, there's a different enforcement mechanism. There's a different way to exit. For example, if you're taking a pledge of shares, you don't need to go to a bankruptcy court. You can give a notice. If it's a listed shares, you can go give a notice and you can sell the shares in the market. So those kind of nuances are very important for the manager and the team in the manager to really know that, because that kind of determines how they manage that risk really.
Got it, Shamal. Thank you so much for that. My next question is for Amit. Amit, how is private credit regulated in India, and what are the key regulatory considerations an investor should have in their mind? And of course, I know you have already touched upon the bankruptcy law, but are there any other recent or upcoming regulatory changes that might impact the private credit landscape?
So I think from a pure regulatory perspective, I think the regulations in India are obviously evolving, and we are continuously improving upon regulations. And we think that these regulations are all going to be for the benefit of the creditors only. So at the end of the day, we do not see too much requirement to change the rules from where we are currently. It's if the same regulations can be implemented effectively, that itself will take care of a lot of those things. Like Shamal touched upon, pledge enforcement has become now very, very crystal clear across all regulations. So you just at a press of button can get your money back because equity markets have the depth. But similar depth is not there in the high yield bond market. But that is also developing. And over a period of time, we have seen, like, for example, one of the deals, one of our cement companies where we are invested in, the largest secondary trade on a high yield bond we saw happening when one of the funds sold to one of the foreign banks their entire $100 million exposure on the exchange. Now, that's like two parties coming together on a high yield debt and buying high yield debt from each other, and the deal happened at 200 basis points lower pricing where the fund was invested at. So the market is also becoming liquid. So any regulations which will improve the functioning of the bond market, which will allow the bond markets to become more efficient, more over the counter, more deep, would be welcome in that area. And I think for that, as we all know, AIFs have become a good structure. In fact, I must tell you, on the liquidity point which Shamal touched upon, for high performing funds, there is enough secondary market also available for a lot of these AIF units. So in India now, structurally, you can invest through a fund which is an alternate investment fund, and you get units of that fund. Those units of the fund reflect in your demat account just like equity shares, and you can actually try and sell these units on a secondary basis through your wealth manager or your channel partner to a eligible person who's willing to buy those units. And we have seen effective trading in, at least I can tell for Edelweiss, we have seen secondary tradings in excess of $200 million over the last 2 3 years for the funds that people are invested in. So all the markets are expanding. So all regulations which are for the deepening of the market, for the structural safety of the market, are welcome. As far as the credit regulations are seen, I think we have got good amount of credit regulations now. We just need to focus on improving the efficiencies of the court, reducing those delays which are currently there in some cases. So just making the process more efficient will do the job for us, Anjali, itself.
Got it. Got it. Thanks, Amit. Before we move ahead, I just wanted to get another poll done. So basically, as an investor, what are the factors that influence your investment decisions? There's a short question with a number of options over there on your screen. Just let us know what has been your top few factors in your mind. Another 10 seconds to answer the poll. Great. So good to see that we are taking a number of factors into consideration before actually taking the investment, which is the right way to go about it as well. I'll stop sharing the results now, and coming back to the topic of factors influencing your decision and keeping in mind the time constraint that we have. In a nutshell, Amit, if you have to just tell our audience over here, what should be the factors, top factors one should have while doing the due diligence of this space?
So when you're choosing a credit manager, and I think it is important for at least emerging markets that you, in our view, choose a local manager where you believe that the local manager has foot on the ground, domain knowledge, skill sets. And like any other equity fund or any other fund, you should look at the continuity of the team, how long the team has been together, what's the experience of the team, how the teams have worked around. Track record is a great reflection of what actually has achieved, because a lot of people can say, okay, the track record is not good in the past, but it can go better in future. But I think somewhere or the other, just having a focused view on the track record of the asset manager allows you to see what they have done if the cases have gone sideways, what has been their strategy for exit, how much capital that they have returned to their clients. So track record is another important vector. And From a private credit perspective itself, I think it is important to understand that though the funds may look longer in duration, you may say that the fund is a 5 year or a 6 year fund. The average duration of private credit funds is not long. So people who are borrowing money, which is at a slightly higher rate than the banking rate, do tend to repay a lot of that money faster. So average durations of deal, how they have been, what sort of money multiple which people have been able to make, what's the recycling that has happened into the fund, all of those are important part to be looked at as a track record. At a deal specific, when the investors are doing due diligence, maybe they should look at one or two key deals into the portfolio, and see what sort of credit thesis has been applied. But more importantly, at a portfolio level, is there diversification, is there too much investment? Because diversification is the holy grail of reducing risk, right? At the end of the day, if you have invested 25% of your fund into one company, though it may be a very great investment, it could lead to certain amount of undue risks. So how diversification is planned, how cash flows are structured, so all of that has to be looked at. But at a very high level, because a lot of our investors do not have the time and the bandwidth, I think my view would be track record is one of the most important thing, and team. So if track record and team are good, then I think a lot of things are taken care of.
Great, great, great. Thanks, Amit. That was insightful. Moving to Shyamal. Shyamal, we wanted to understand from you now that we have understood from Amit in terms of how do we go about it, what are the factors. Then say if someone has made their mind and they want to invest in this particular space, and more specifically about India private credit space, what are the current ways to go about this investment, and are there any limitation or qualification criteria for the investors?
So I think regulatorily speaking, the limit, I think there are essentially two things which are there. One is the minimum amount which is specified as 1 crore or equal to US dollar $125,000. Second, I think more importantly, I think it is very important. Two things are very important. One is that the investor has to really understand, because there are, there's a spectrum of private credit funds starting from a performing credit which is starting for, let's say, 12 to 14%, and there's a performing credit which is at 14 to 16%, and there are special situations which is at, let's say, 18%, distress at 20%, real estate, venture debt 20-25%. So there's an entire spectrum. So private credit is not a single thing, it's a spectrum, starting from bank debt going up to the distressed debt. So first of all, the investor has to really make up the mind is what is the risk return profile that they are comfortable with, number one. Number two, they need to be comfortable with what the mandate of the fund is, that what is it they will do and what is it that they will not do. Because if a performing credit fund goes and does, let's say, lends to a company which is, had a distress in the past but now it's performing, that's not really performing credit according to me. So I think that is very important to really deep down and not just go by the headline, and look at what is the kind of assets that they're actually going to do and whether they're comfortable with that risk or not. So I think other thing which they need to look at is the alignment of interest, whether the manager's team is aligned in terms of the whether there are any the returns of the fund are aligned, the team is aligned, whether it's the skin in the game, how much money is the sponsor putting into the fund. And so I think that is the other segment really factor that they need to really look at. And I think also very important to see whether there are no conflicts of interest, right? I mean, there should be arm's length between various verticals, because I think it's very important that the asset management business should be an important business for that manager, and not just another business that they do. And there should be a clear-cut division in the arm's length perspective. So that's very important. I mean, these are kind of things that they should look at. After having understood the risk and return, I think process is pretty simple. I mean, like for example, if they want to, for example, invest in a performing credit fund, obviously the risk is much lower, as we discussed. It's similar to what a bank debt will be, but with the different end use and different collateral and different structure or a different capital charge. But the process is pretty simple. It's slightly different from a mutual fund, but like typically there'll be a usual, the form will be there, there'll be a KYC documents will be required, and there is a subscription or a contribution agreement which is different from a mutual fund scenario, which typically nowadays many of the managers are really getting it done digitally. So it's not very operationally intensive. Now, practically speaking, now there are two segments of investors. One segment is the domestic investors, and second segment is the offshore investors, because there's a lot of offshore, especially NRI and or India linked investments which are coming in. So somebody who wants to invest in the fund from offshore, he could do it directly as well, or he could go through a feeder structure. If the fund has a feeder, let's say either in Gift City or Singapore, and they can really use that to really kind of route the money into the Indian fund. Domestic is pretty straightforward. Even the offshore is pretty straightforward if you're coming through the feeder route. There's no difference if you come directly versus vis-a-vis coming through feeder. It's just that it just makes the process a little simpler and smooth for the investor really. So I would say that to net, it's a simple process, not very complicated. But what is important is that the investor really understands the risk that they're taking and the return. Obviously, there's a risk and the return, because unlike equity, where equity goes down by 20-30%, people understand that equity has that risk. They need to also understand that credit also has a risk. Obviously, diversification helps. I totally agree with Amit. I think diversification is one of the strongest tools and probably not as well understood as anything else. Just to give an example, if you have just an example, if you have 10 investments, I mean, typically a fund will have more than 10 investments, but assuming a diversification of 10 investments, one investment kind of doesn't give you any returns at all on the coupon side, and you get a recovery of 40 cents, which Amit mentioned that is the normal average kind of return you're getting from many of these good corporates. So the return, the overall return to the investors falls by approximately 2% in that case. So if he's getting 16%, he will end up getting 14% gross return, and net will be accordingly lower. So that's the powerful tool. Now then imagine a situation where instead of 10 investments, there are 15 investments, your risk keeps going down. So I think the diversification is another thing that investor needs to look at when they're actually investing in a fund. So I think these are the factors they need to look at, and then process I don't think is very complicated. Eligibility minimum 1 crore, and that's about it, I guess.
I
Great,
think
great.
Anjali is doing less marketing for Crystal. I think Crystal is a good tool to invest. I think they pull up investments for HNI investors into India, and I think it's a great way to invest into some of these private credit products that are around the corner. But if you are an Indian national, investing in AIFs is pretty simple and easy. If you are sitting out of Singapore, you may have to look for some feeder funds which fund into these AIFs into India, or directly invest into India as a private credit as FPI. But basically, two key elements of investing. One is through AIF, which is India domiciled, and one is through an FPI, which is typically Singapore or Mauritius domains, depending on the asset manager, which are used as FPI investments into private credit in India. So broadly, two methods.
Great, great, great. Thanks, Amit. Thanks, Shamal. Cognizant of the time, before we move to the Q&A, just another quick poll to understand how we think about the Indian private credit space. Are we bullish? Are we bearish? Are we neutral? Or we haven't just made up our mind yet? Another 10 seconds to answer the poll. Awesome. So as the results says, I think both our speakers would also agree that we are quite bullish as of now on the Indian private credit space, and for the right reasons, which are already discussed on this call as well. Now, quickly, I'll move to the Q&A section. So Amit, we have a question where our audience wants to know in terms of, could you comment on the structure of the deal? Anything which is noticeably different versus the rest of the world? I'm assuming he's talking about the Indian private credit space. And what are the rating system in India?
So maybe I will just give a slightly longish answer. It could cover more questions than in the whole thing. So as I said, I think India private credit, the structures are fairly simple. As I said, non-convertible debentures are the structures through which it is invested. I think Shyamal and I both have touched upon what are the various risks and return profiles in these of investments. The average tenor for individual transactions I have seen has been between more like 2 to 3 years. Though the deals happen for a 5-year maturity period, but an average tenor of the deals have been 2 to 3 years. in which most of the private credit deals are refinanced. The fund tenors are in the range of 5 to 7 years, depending on what sort of maturity funds that you are looking at in the private credit space. But one can expect around a rupee, and all numbers I'm talking in rupee. One can easily, depending on which risk profile of private credit fund it is going, from performing credit to high yields, it can expect anywhere between 14 to 20% gross INR returns, depending on various categories of the funds and the risk profile one wants to choose. And various asset managers have various fee structures. The fee structures are lower on the 14 to 15% side because the net yields of the clients have to be higher, they're slightly more on the 20% plus side structures, because those are high yield situations and have to be created and monitored very well. uh, if the investors were looking at dollar returns, anywhere between $10 to $14 is what is the net range which the investor can expect to achieve by investing out of. And these are all unlevered returns I'm talking about, unlevered and unhedged returns in that sense. And I think Indian currency is, in my view, and this is just my view and could be wrong, is not going to depreciate as much as it had done in the past. Last 25 years average has been around 3% currency depreciation. Last 1 year there has been no depreciation in the currency. And if you see the inflation rate differential, which is what drives a lot of currency between US and India, is at the narrowest ever. If US is doing 4% inflation, maybe we are at 5.5% inflation, which is the most least divergence at this point of time. Again, the risk-free rate, the lowest, US rates used to be zero and we used to be 5.5. Now US has come to 5 and we are still at 6.5. So the amount of difference in the US interest rates. So I think Indian currency, given the strength of the economy, the pace of the economy, we are the largest economy, growing at a pace of 7% today. I think overall it will lead to a situation where the depreciation of the currency will not be so much in the forward against USD, which will add some shine to the investor returns at the end of the period. So I think it's a great time for people looking for sort of regular cash flows, annual cash flows out of their portfolio, instead of waiting for 7 years like private equity. If they're willing to take money every year back from their investments, I think private credit is a great place to invest in India.
Thanks, Amit. Thanks. There's another
I've
question.
tried to cover 4 or 5 questions
Right.
in one answer, which were there on the panel.
Sure. There's also another question in terms of how do retail investors participate in this market. So to that, I'll just like to mention that Crystal has a lot of offering on their platform. And what we try to do is we try to fractionalize all those investments. So all the different types of investment that Amit and Shyamal talked about, all the different types of transaction, we have a variety of those on the private credit and many other space as well on the platform. So of course, if you qualify to be an investor in this particular space, there is definitely a number of options you'll find on the Crystal platform, and you can reach out to us and we'll be more than happy to schedule a call and take it ahead and explain it to you in detail what are the available options in a fractionalized manner. There's another question. Probably I'll redirect that to Shyamal. Shyamal, our audience wants to know in terms of how does direct lending in developed market, such as US, compare to the private credit in India? Of course, this has been partly answered as well, but if there's anything that you would like to add upon. And they also want to know, do you see unitrans solution prevalent in US becoming a trend in India as well?
So I think we discussed this, I think before the call also briefly. So what I have seen is that in the US markets, typically I think it's pretty covenant light. Most of these transactions are not as well structured as they are in India. I mean, India, obviously we've gone through multiple cycles and seen that the value of collateral and the value of covenant and the value of credit enhancement. So to that extent, I don't see the Indian markets to really kind of go light on the covenant, especially when you're operating in this segment, which is slightly higher risk than your usual high grade bonds, etc. So I think that is where I see it. I don't expect a dilution on the covenant side. So to the extent, the Indian private credit market will be different. In terms of I think as Amit also mentioned, that I think most of the transactions are, I think people prefer it simple. I think we have seen time and again, more complexity brings more complications. It's always good to look at simple, I mean, branchings have been done in the past. Most of the transactions are typically done on a senior secured basis. There is subordination in some transactions, but those subordinations are in the form of back ending of the cash flow. So let's say example could be that let's say banks, for example, in India, they require a monthly coupon because that's what the regulation requires. So in the same company, company, there could be two tranche issuances. One tranche could be done for a bank, which could have an early repayment on amortizing schedule with a monthly coupon, and the same with the same security structure with a same security package and governance and the covenant. The private credit fund could come in with a back-ended structure with maybe a low coupon or a zero coupon and a back-ended repayment. So that kind of a structural subordination through cash flows is something which we are seeing more and more, and that does give a lot of alpha in terms of the increase in the yield that we see in those transactions. So while you are from a security perspective, you are no worse than anybody else, but you are actually getting a higher premium because you are okay to take that kind of a risk because you looked at the same company and overall you're comfortable with that credit.
Got it, Shamil. Amit, you had mentioned about the secondary sale in terms of liquidity one can opt for. There's a question with regards to that. In case of secondary sale of AIF units, how is the transaction processed?
It
Is
is basically through it's an OTC thing. It's not on the market, so it's over the counter, and you will have to contact your wealth manager. So typically, if a private wealth manager is associated with you who has placed your product, then the private placement manager can sort of find a buyer for your product. And once the buyer and sellers have agreed upon the pricing, which could be different from the NAV, because as I said, it's over the counter, then the AMC can just register the transfer. The AMC does not have a role to play. It's typically the wealth managers who do this.
We have a number of questions as well, but considering the time, we're already short on time. I just want to go to Amit to brief us on what Edelweiss Alternatives are doing and what they are doing particularly in this particular space. Maybe in just quick brief 2 minutes time, if you can explain us that.
No, sure. I'll just very quickly. Edelweiss Alternatives is one of the largest alternatives player in India. We manage $4.5 billion under AUM. We have a 13-year track record of delivering value to our clients. Our investors include large public pension plans from US, Canada, Europe, and insurance companies. Apart from retail domestic investors from India, which include very high net worth individuals and family offices. And we have a lot of Asian clients as well, investing through the Singapore feeder funds like those of Crystal itself. We run three strategies: performing credit, real estate credit, and special situations credit. And all of these strategies are in their third vintages and have a very strong track record. We are almost a 300 plus member team as Edelweiss Alternatives, and we very much value the time of all your clients and investors here on this call. Thank you.
Thank you, Amit. Thank you. Now, Shyamal, we'd like to understand from you in terms of what RV Capital is doing in this particular sector, and if you want to just brief us about that.
Yeah, so for RV Capital, as a Singapore-based asset manager, we've been around for more than 12 years, currently managing a AUM of $1 billion across 5 strategies. 4 of them are offshore, and the latest one, which is it's an onshore domestic foot on the ground AIF, which is focused on the private credit segment. So that is broadly where we are right now. Most of the investors that we have, almost 80% to 90% investors, are institutional investors, because that is the nature of, I mean, kind of the track record which has been built up, which has really got that to that place. We are right now starting out in India, and we already launched a fund. A couple of transactions have been done, and we are in the fundraise mode currently. It's a domestic private credit fund, so that's probably about it.
Thanks, Shamil. For all the unanswered question, we'll be happy to schedule a call after the webinar. Just reach out to us. We'll be happy to get on a call and explain everything about this particular space to you. Any closing remarks, Amit, Shamil, that you want to make?
No, I think just a very thing. I think private credit has been around for some time, and it's just growing in India. I think India is doing fantastically well as a country and economy. We are on a good growth path. A lot of consumers, given our population, and a lot of new businesses ideas and coming up. So private credit will be an important vertical in the country's growth, and I think we will see private credit playing in a more and more important role in the country's economy. And I think investors should look at these opportunities as a part of their asset allocation. Just like diversification in a portfolio is important, similarly, diversification in your personal portfolio is also very, very important. So as you drive towards creating a long-term sustainable return in your portfolio, I think private credit is a must in your portfolio allocation. Apart from equities, which everybody understands intuitively, so easy, but private credit has a lot lesser risk profile than equity, but very similar returns, or marginally lower, but very similar returns as equities. So it has a portfolio allocation, and I will urge all your clients to please look at their portfolio allocation and never be over allocated to any single strategy.
Absolutely, absolutely. Shyamal, any closing remarks from your side?
No, I completely resonate with what Amit said. I think it's actually a segment which has not been looked at in the past, because I think it was always limited to asset class like typically bank deposit or high yield mutual funds, which are actually having an alpha of almost 500 basis lower. So now that we are at a stage where the pricing has got corrected, risk return wise looking attractive, there's a growing wealth, which is wealth creation, which is happening. But it's very important to really kind of take stock, because incremental how much growth is coming from various asset classes one has to see, because there's a place for everything in the allocation. And private credit definitely needs to be part of any investor's allocation. And another thing which I want to just mention again is that I think we are very different at a different space from a macro perspective from the past. I think right now, if you look at macro, and this is not just now, but we've been seeing this over the period of time. I think whether you look at fiscal deficit, whether you look at inflation, the way the monetary policy is being managed, the way the currency, I mean, the last 1 year currency and the rates, they traded in a very, very narrow range. I mean, India was actually almost like a developed economy in terms of the lack of volatility in the market. And so I think we are in a different space now. I don't expect the rupee to really depreciate the way it has in the past. And the last 1 year is a good example. So it really makes a lot of sense right now. I mean, both for onshore investors as well as offshore investors. And we have a working bankruptcy process in work. We have a working legal system and which is incidentally one of the few Asian countries. India is one of the few Asian countries where actually you have a working bankruptcy process, which is interesting to know. If you take away Japan, for example, or Australia, New Zealand, there are not that many actually. So I think there are many reasons to really look at this segment strongly, and I think their overall outlook looks pretty positive. On a risk-adjusted basis, definitely it makes more sense, because you're getting almost equity-like returns on a contractual financial obligation, which actually is supposed to pay you out much earlier than what a private equity will.
Correct, correct. Yeah. Thank you so much, Shamil. Thank you, Amit, for enlightening us today with on the various aspects of private credit. Sincere thanks to everyone who have joined the session, and we'll be shortly circulating this video as well in case you would have missed out some other aspect, or if your particular topic was not covered over here, or your question was not answered, feel free to reach out to us at support@crystal.ai, and we'll be happy to schedule a call or reply to you over email.